Welcome. Things are changing rapidly with respect to the economy and the stock market, and I wanted to make sure you are up to date on all of the things that are going on. Now, like I said, things are changing rapidly, and it's a lot of it because of the fact of what the Federal Reserve is doing. Now, our federal chairman, Jerome Powell, has really come out and said that he wants to be fighting inflation at all costs. So when we take a look at what's actually happening, is he doing a good job? Well, we still have an increase of prices that are going on with respect to commodities. So they're increasing, but on a lot slower basis. So that's going to probably start rolling over here at some point in time, and prices will start coming down. But what is also happening is the fact that he's looking at all of these different indicators to the point that we still are seeing some job growth. We're still seeing a little bit of complacency, so to speak, with kind of the volatility of everything. And because of that, it gives him more leeway to continue to raise interest rates. Well, one area that we're already starting to see things start to break is with real estate. You see mortgages the mortgage refinancings are down. We have new purchases of homes are significantly down year over year, and that is a direct correlation to prices and what the Federal Reserve doing to raise interest rates. So we have that going on one side here, and we have a Federal Reserve that is really trying to increase interest rates correctly to curb a lot of this inflation. So in and of itself, that's not a bad thing. And under normal conditions, the economy can sustain itself and stand these increases that we're seeing, but not all the time. The other aspect of things that we're starting to see is the fact that more and more consumers, people that are purchasing things, so you and I, are not purchasing things the way we did a year ago. So all of these companies now, so think Target, think Walmart, think Apple, the kind of direct to the consumer type of a company, those are doing worse this year than last year. And so when we couple that with the fact that we have a higher rate of inflation that's happening and most likely will be here to stay for a period of time, all of that means that we're going to have less money to spend on other areas other than food and shelter. So that's one of the main reasons why this is not going away anytime quickly. This environment that we're in, this kind of bad time and feeling with the economy. And what's worse is that the fact that we're having a lot of people putting more and more onto credit cards. So we're having a savings rate come down. We are having the credit card usage go up. We are basically hoping that things get better in the future and that we can be paying off those credit cards. And when that doesn't happen, that comes to the point that now that you're going to have to start declaring bankruptcies. We're going to start looking at buying less goods. All of these things translate into really a slowdown of the economy. And that is the reason why I have said before that coming into this period of time right now that we are in this, what I call a lead 4 environment. So Alliance Wealth Economic Activity and Development Stage 4, that's where we have deflation, or in this case, a slowing, a disinflation that's going to be happening. So it's not necessarily deflation, but it's a slowing of the inflation. And we also have a slowing of the economy. So slowing inflation, slowing economy, all of that leads to a bad time. Now, coming into the summertime, the end of summer, coming into fall, it was supposed to kind of swing back the other way, and we were supposed to have a little bit of growth happening again, basically heading into that time with the economy. That is changing also. So we're really starting to see cracks form with the economy, and that could mean that we are in this prolonged period of time that we need to be really managing the risk of our accounts more than trying to have a fear of missing the next upturn. I don't believe that any upturn from here in the stock market is going to be sustainable because of the fact that there's too many companies that are doing really poorly this period of time. And think of companies like Snap. Well, most likely you're not using Snapchat, the social media platform, but they're down 46% in a day. Then you have companies like Facebook, like Google, Amazon, Tesla. All of these are companies that are well known that you know, and these are down significantly 20, 30, 40, 50% over the course of the last 6 to 9 months. So with that, that's the reason why we're in this environment that good companies are starting to get hurt. And when that happens, it's a time to just be sitting on the sidelines and letting this pass, this environment pass, versus trying to have a fear that you're going to miss out on the bottom and calling the next leg up in the stock market. So when we take a look at what we call the price, where we're at today, the volume, and the volatility of everything, we are not in a place to say that we should be growing our assets. We are in a place to say we should be protecting our assets. With that, reach out as you have questions and want an opinion on where you're currently at with your portfolio, and have a great rest of the day.